This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. It is not intended to cause or induce breach of an existing agency agreement.
Hello? 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 This is the Vancouver
Commercial
Real Estate Podcast.
And welcome back to the Vancouver Commercial Real Estate Podcast. I'm Cory Wright.
And I'm Adam Scalena. And Cory, this is, man, your voice is still, it's like doing a podcast with Leonard Cohen.
It's like, well, the problem is after the last episode, I was off to Whistler for the annual ICSC Whistler Conference, which is the International Council of Shopping Centers. So we've got a big booth in the show, and there's hundreds, if not thousands of people that come by. The whole thing. So the whole time you're talking to people, you're yelling, like it's just.
How are the parties this year?
Well, I'm not the one to ask because I'm like, well, it's so funny because on the second day, or the first day of the conference was the Monday. We all get up there on the Sunday to get set up. On the Monday, I'm talking to people like this, and instantly like, oh, how was Buffalo Bills last night? And they're assuming that's where I got my voice.
You were singing too loud.
And I was like, no, I had this before. This is the end result of a fever for some reason. This is not me dancing on the bar at Buffalo Bills and Whistler by any stretch of the imagination. I leave that up to other people in the company.
The younger brokers. Yeah. Well, we got a great episode today. We've got Jon Switzer on the program. He is the managing partner at Impact Commercial. Jon's super tapped into the market. Today, we're talking about everything from where commercial interest rates are, what's happening in the economy, what's happening in the commercial market, assets and regions, geographical regions in BC that Jon's excited about. We talk about the cap gains tax. We talk about the threat of tariffs coming in on Saturday, 25%.
Yeah, Mr. Trump.
So we talk Trump, tariffs, and everything. So anyways, this is a great episode. Really fortunate to have Jon on the program. Without further ado, why don't we cut to our conversation with Jon?
Great episode, guys. Enjoy this one.
This podcast is presented by Impact Commercial.
Impact Commercial, Jon, Alan, the team over there are fantastic. They've all been on the show.
They have,
friends of the show.
Great guys.
Wealth of experience. They can help with all your commercial financing needs.
Whether it's owner-occupiers, land development funds, commercial investments, or multifamily, these guys got you covered.
And they recently obtained their CMHC correspondent lender status.
So for all your commercial lending needs, visit them at impactcommercial.ca.
That's impactcommercial.ca.
Okay, so we're here with Jon Switzer. He's the managing partner at Impact Commercial and fan favorite.
Absolutely fan favorite.
Recurring guest. Jon, how you doing? Thanks for taking the time today. Can you maybe start by telling our listeners a little bit about yourself?
Sure. So I've been with Impact now for 8 years, roughly. And I started out when the team was much smaller, and now we've grown to 8 of us in total, kind of 6 brokers, 2 analysts, and always a bit of a moving target with those numbers. But I took over the managing partner duties about 2 years ago, and loving every minute of it. Lots of exciting things going on all the time, especially in the last couple of months, it feels like.
Right, of course. Can you maybe start, Jon, by giving us a little bit of for our listeners, what's the landscape like in commercial mortgage lending right now?
Yeah, it's actually good timing for this conversation, right down to the day, because we're down to I think around 2-year lows on the yield curve, particularly the 5-year Government of Canada bond yield is hovering right around that 2-year low. I'm just looking at the chart here. So it's kind of one and a half years since it was down at this level. Sorry, 2.5 years. That back in August 2022 was about it was right around here. So we're looking like we could kind of keep trending lower here, and then we'd be entering unknown territory from the last few years where we might get down into the mid to low 2% range for the 5-year bond yield, which is very positive for fixed mortgage rates. And then obviously variable rates are more closely tied to the Bank of Canada overnight rate, which is directly correlated to the prime rate or the bank prime rate. You'll often hear it referred to as. So that is after the 25 basis point cut this week, we are now down at 3% for the Bank of Canada overnight rate. And that translates to a 5.2% bank prime rate.
And if you know
things are trending in the right direction.
Trending in the right direction. And can you talk about and just for people that have kind of been, watching the market to some extent, but can you talk a little bit about just the last calendar year or so in lending? And are you noticing an uptick right now, or how are things right now?
It's been quite a volatile stretch. Like I would sort of preface it by saying that bond yields drive the commercial debt market in general, because, as I mentioned before, the Government of Canada bond yields dictate fixed rates. We don't do as much variable rate financing on the term side. So right now I'm just talking term mortgages. Construction's a whole different animal. But on the term side, we're almost completely driven by our fixed rates, because variable is just a lot more expensive in commercial, and it's much less frequently used in term. So we've seen that 5-year Government of Canada bond yield go well above 4% at one time in the last couple of years. I guess that would have been around the end of 2023. We were up around 4.25% on the 5-year bond yield. We're now down closer to 2.75%. So like full 1.5% fluctuation in just the last kind of not even a year and a half. That makes it very hard for investors to kind of plot their course or to do any kind of reliable projections. But having said that, obviously things are looking a lot better now, and we are feeling that in market sentiment, in the transactions that we're seeing coming through the door. We're seeing a good variety of owner users, which are I'd say they're some of the first ones to come back to the market when we start to see rates come down, because they're just waiting for a window of affordability where they can secure their own real estate instead of being subject to the whims of a landlord. So they kind of started flooding back in first, and now we're seeing a decent breadth of activity across investment properties as well. There's been a couple good sized retail transactions, like strip mall type properties, and then some larger ground level retail stuff has been going on. So yeah, it's just a lot better sentiment, and I can tell you that's going to be improving every day for pretty much the last couple of weeks. We've been sliding lower on that 5-year bond yield, so things are looking up.
So, John, from an investor standpoint there, how would that translate into what type of industry I could expect? So I'm buying this retail plaza. Let's say it's a good one. I'm looking at a 5-year fixed rate with you right now, assuming that it kind of ticks a lot of the boxes there that a lender's going to want to see. What type of interest rate could I expect?
Yeah, if you're looking at more conventional lenders, so
yeah,
we'll exclude alternative lenders, which are more expensive, and we'll exclude for the time being, like life insurance lenders that are on the lowest end. So if we just talk kind of, major banks and credit unions, we can get some of them as low as probably bond plus 180 basis points, or 1.8% these days. So right now, if you're looking at a 5-year Government of Canada bond yield of, let's just round up to 2.8%, then you're looking at about 460 at kind of the lower end of conventional lenders for, I'd say for most assets, if it's a strong borrower profile and good quality property in a good location. And then, of course, you get, we're also excluding multifamily from that equation, which is heavily reliant on, CMHC financing.
And that's one thing. That's why I wanted to ask the question, because maybe a lot of borrowers may not realize that you're looking at sub-5 interest rates now to get some of these good assets on a 5-year fix, where they watch the news, the media. They may not be able to correlate or translate how those numbers come together. So if I'm getting a 4.75%, because I tick all the boxes, conventional 65% loan to value, maybe on it, the lender likes the asset, they like me as a borrower. How does that number compare maybe to like pre-COVID type numbers? Are we in a situation where 4.75 is a good lending rate today and was also a good lending rate maybe in 2018 that people just don't realize that we're kind of in that same marketplace from a debt perspective?
I feel like that was a slightly leading question, and it's a great point.
I surround myself. A lot of my friends are lawyers, not working for me in a bad way, but they're always teaching me how to lead the witness.
So yes, you're bang on. Like when I started in the industry, late 2017, this was the long-term average, was like mid-4s for commercial on a 5-year fix was just what everybody was used to. That was the norm. That was healthy. We're basically right back there now. The slight difference is that leading up to this, we had the longest yield curve inversion in history. So that's just when, 1 and 2 and 3-year rates are higher than 5 and 10 year. And particularly the actual definition of a yield curve inversion is when the 2-year bond yield is higher than the 10-year bond yield. So that was in place for a very long time, and that's usually indicative of an incoming recession. Whereas when I started it, things were very sort of normal economically, and the markets were flying. So we're definitely in like a settling out period here where the market's starting to find its footing again, and the yield curve has become very flat. So it's healthier than the inversion that we were experiencing for a very long time.
So Jon, just to timestamp this episode, it's January 31st today. We woke up to the news that Ottawa announces a deferral in implementing its capital gains changes. What are your thoughts? What does that do, I guess, to the commercial real estate marketing from the lending lens? And we've been kind of talking, and not to, again, lead the direction you want to go with this, but we've been talking about the potential of this shaking loose some inventory as well.
Well, absolutely. There has been a significant amount of chatter. We talked to lots of investors, lots of commercial realtors that have their ear to the ground, and it really was having a major impact on vendors' willingness to list their properties. And we were hearing real world examples of that on kind of like a daily, weekly basis. People had got this great client. He was planning to, he's getting on in years, planning to raise capital, and now they're just putting everything on hold to see how this shakes out. So I know everybody was disappointed, including us, when we heard that the CRA was going to keep implementing that. They were taking it as I think it's referred to as like a directive of government, or a direction of government that they felt they needed to continue to implement it. And then we had some very, notable accountants and investment advisors saying that people just needed to keep paying it, but they expected that it would be refunded eventually. And so this news this morning is a really positive thing, just to remove all that uncertainty. There's enough volatility and uncertainty out there right now that that's just one we can strike off the list. So it's very positive for market sentiment.
Well, I think the thing too is, me and Adam were talking before we hit record here, is just, there's obviously been a lack of inventory in the commercial side of things still. And not that inventory really starts to come out in January on a normal basis, but I think a lot of people leading up to 2025 are really anticipating things to really pick up, maybe a lot quicker than expected. And the inventory levels just haven't really seemed to really come up to a level that would be maybe eye-opening. A lot of product that hadn't sold last year has sort of been recycled back into the market. But we just haven't really seen an influx of new stuff. And I think one conclusion you could kind of draw was the uncertainty around the capital gains. I know when Mr. Trudeau had stepped down, a lot of the stuff they proposed in their budget and tabled would also kind of go with that. And then the CRA came out the very next day saying, hey, wait a minute, guys, we're still going to issue everything as if it's a higher inclusion rate. And then now I think them coming out and saying, hey, we're going to delay this in quotations until January, that might actually spur more inventory into our market, which is much needed right now. Because I think a lot of people were looking at the capital gains, and when we have properties that are generational, you're talking maybe hundreds of thousands of dollars, potentially more in capital gains on these big, huge 10, 15, $20 million dispositions, that I think this actually is a very good sign. And I think it's a good sign for our market that, getting that back in there should really, really spur it. I know one thing too that we were talking about that we haven't really touched on just yet, and obviously I know this is going to be going very political here. Our good friend, Mr. Trump, has a February 1st deadline to impose 25% tariffs on countries such as Canada. I'm curious to see, how has the bond market reacted to that? What are you guys seeing on the lending standpoint? How are lenders kind of looking at that? Obviously, he's said a lot. Not everything has come to fruition, but I think this is something he's backed himself into a corner to now that he's got to deal with. What are your guys' thoughts, and what are you hearing from the lending world on how people are perceiving this?
Yeah, it's interesting. I think it's more directly affected our currency than anything else. Like our currency has taken the biggest hit between diverging from the US on rate cuts pretty significantly. So our dollar was already headed down very drastically, and then this tariff talk started coming out, and it's just given it basically zero opportunity to recover at all. So I think that's where you're seeing the most pressure. And then it's more of a conversation with investors and actually particularly developers right now. The developers I've been talking to, a lot of the guys have been saying they're completely pens down right now until there's more clarity on this, just because imagine if you're building a tower and the cost of materials being a complete unknown, you can't reliably pencil out any kind of pro forma.
Yeah.
So these guys are just waiting. I can't say it's really going to affect available capital from lenders. Like if an investor is willing to invest, and so back to more sort of like term debt, if someone's willing to invest and the lender likes the security in the borrower, they're still going to lend. There's plenty of capital out there looking for a home. So I would say it's going to affect the development side a lot more. There will be a lot more scrutiny, a lot more contingency built into pro formas, that kind of thing, right? So,
what do you think the market does this year with this much uncertainty?
What is the market going to do this year? I wish I could confidently tell you that, but I love where interest rates are going right now. I think actually one of the interesting trends I was thinking about with the whole, like 15 hours notice you gave me for this was
no, don't over exaggerate. It wasn't 15. I probably texted you like 45 minutes ago.
Was just that we have like a very different picture across Canada. You've got a much higher unemployment rate in Toronto than you do in Vancouver, and that's, everybody just automatically, myself included, usually thinks about Toronto as the powerhouse, and we're always kind of the little brother lagging behind or whatever. But Toronto's employment rate is approaching double digits, and we're still down in like that 6% range. And then you've got even higher unemployment rates in parts of Canada, sort of like middle Canada. So what I think could happen is you start getting the government looking to bail out, the rest of Canada and injecting liquidity and probably lowering interest rates further, although that's highly debatable right now, depending who you ask. but also if that unemployment and soft labor market starts to head us towards recession, then usually in a recession you get the bonds trading higher, which the inverse is always bond yields. So that would mean yields and interest rates going lower. So we could have this confluence of events where the government feels they have to, the government and the central bank feel they have to prop up the weakest parts of Canada, but it's one policy for the whole country. So that can be a real propellant for the tighter markets like Vancouver, right? And this has happened cyclically over the decades and historically. So that's one thing that I think is a very strong possibility. That, just to sort of try to sum that up, is like you have to prop up the weakest parts, but we don't have multiple policies across the country. If you provide more liquidity to help the weakest parts, then the strongest parts are going to benefit from that, right? So,
does Jon Switzer buy commercial real estate in 2025?
Yes.
There you go. Problem solved. I think one thing too is one thing we've been echoing to clients across the board is obviously there's a lot of stuff in the media there, but my question earlier about interest rates today versus 2018, we're trying to tell people that the interest rates you're seeing today is what we saw pre-COVID. So it's not like the COVID era, you got to almost take that out because that was unrealistic. But if you look at the interest rates you're getting today on commercial assets and what you were getting in 2018 on commercial assets, it was really, really similar. That, if you're sitting on the sidelines waiting for them to get better, unless there's probably a major black swan event, and maybe the tariffs is that black swan event, is they're going to be what they're going to be. That you're not sitting there to get these like unrealistic 3.5 or 2.75% commercial interest rates. You're going to get 4.5 to 5, and that's a healthy debt market. So it's like we're encouraging people that if you're sitting on the sidelines waiting for that, it may not happen.
No, it's very true. And I would say the biggest difference back then was higher cap rates. There's just
good point.
Real estate's gone up so much since then, but the biggest pain point was when we had peak interest rates and peak property values. So nothing made sense. Whereas now you've had a major pullback in commercial real estate values. So it's starting to make sense again that cap rate interest rate relationship is that sort of aligning again to where it makes a lot more sense. We've done we did one conventional 75% financing on the island this year of a strip mall, and that was the first time I've seen conventional 75% financing in like a major market since probably 2018. So for me, that was a real indicator that there's some balance coming back to the market.
I guess, John, as a final question here before we hit you up with our custom-made Jon Switzer six-pack today, is there any markets you're excited about, or is there any markets that you're seeing maybe more deal flow coming in or lenders are more bullish on? Is there a market that you're going to in 2025?
Well, I know you like the island. And
Nanaimo.
Nanaimo. Nanaimo, but just the island in general, we're seeing some of the major lenders, I'm thinking particularly credit unions in the lower mainland that historically haven't really looked seriously at the island, are now actually asking to be included in applications for island properties. So
very interesting.
I think, that market's going to continue to be really strong. And then you had a whole bunch of, that's more like a general commentary, but then more specifically, you had a pretty sizable build out of industrial shell space on the island that has been slow to be absorbed.
Yeah, very good point.
And as a result, the prices have come crashing down on those back to, like probably 5-6 year old levels. So I think those are going to look really good if somebody were to swoop in now. You tell me, but I think they're getting down to around $300 a foot. And
they're definitely coming down. I think one of the challenges was, and this is one thing that when we talk to investors, we always try to preach, it's an island, right? So it's an island in a good way because there's no more land. It's an island in a bad way because it's an island and it's restricted by land. And when there was a ton of industrial product getting built, it was a matter of, is this pent-up demand that's just going to flush itself out? Or is this ongoing demand? And when you look at over here in the greater Vancouver area, in the Fraser Valley, we've had a healthy dose of inventory, new inventory being delivered on an annual basis through development that was consistently being absorbed, keeping prices high, lease rates high, and vacancies low. And that's one reason why we're so bullish on that asset class over here, that when we get to that end of this year, early next year, where there's going to be a problem with the inventory because the product that wasn't getting built, that will be, I think, have impact on it. You go to the Vancouver Island market, or especially the greater Victoria market, and it's been very slow to absorb. Prices have come way, way down, and it's been proven it's not ongoing demand. It's been proven it was pent-up demand. And once that pent-up demand flushed itself through the system, it was a tough road. And there's product, I can say with confidence, that I think has been probably leased or on the market for lease or sale in new construction, going on 3 or 4 years of the marketing cycle from when it was originally marketed.
Yeah.
And there's still products sitting there. So, I mean, that's an asset class I think is going to be very challenged, at least in the foreseeable future there, until we get some good absorption. But the prices coming down as much as they have, they're making it much more palatable for buyers. And that's been a marketplace or an asset class that traditionally has been targeted towards owner-occupiers. A lot of investors swooped in and got into that when the rates started going up. But now those investors, I think, are in a very tough position, because now you're not getting those great cap rates because the lease rates have fallen dramatically. And when you look at $20 to $15, it doesn't sound like a lot. It's $5, but that's 25%. Like, that's a lot of money.
Yeah.
So I think that's definitely, to your point, is going to be an asset class that will be challenged, especially in the greater Victoria area moving forward, potentially.
Yeah. And then I think in the longer run, and this is actually going to be a similar story probably everywhere for residential condos and call it industrial condo or strata, is because of those market fundamentals, there's not enough development happening now. And we're going to have several years of very little new projects. And that kind of started, a year and a half to 2 years ago off the top of my head, where it was basically, 2022 at some point when we started seeing the rapid rate hikes. Yeah. That started to cool off, and it certainly hasn't come back online and probably won't for a while. So if we do see that scenario play out where the Vancouver market starts to tighten again, you're going to have a supply-demand problem that could develop pretty quickly again, as investors want to all clamor into the market. They'll get a little bit of FOMO, and then that can easily spread to the island and the bigger markets in the Okanagan. So things can just, I think people forget, and I'm guilty of it too, of how quickly things can change. But when you've seen a few of these cycles, you just look back in history, and it can
changes on a dime.
Yeah. Big time.
Yeah.
Well, Jon, you know the drill. We got 6 lighthearted questions to ask you here before we let you go. Do you have a few more minutes for us?
For sure.
The 6-pack is powered by our good friends over at Red Point Law.
Red Point Law, Cory, Tim, Falco, Scott, and the team. These are great people with a wealth of experience when it comes to commercial closings and private lending. And I just want to say, Cory, not to cut you off, they have a perfect 5-star review on Google.
So for all your commercial legal needs, visit them at redpointlaw.ca, with offices in Vancouver and now open in downtown Kelowna.
All right. First question up. Are the Canucks going to make the playoffs this year? I know you're a hockey fan. Are we going to make the playoffs? Before I'd ask if you want to win the Stanley Cup, but we got to make the playoffs first. So are we getting into the playoffs this year, Jon?
I do think so. We were getting dangerously close to 500 there, but we've won 3 in a row. I think, unless I could have missed a game last night. I have 2 young kids, but I know we won at least 3 in a row. So we're back up to a healthy cushion above 500, and it does feel like we're on a tear right now, and we're battling through some of the problems everybody who follows the Canucks are aware of. So I think it's shaping up a lot better than it looked.
Good.
So long ago.
So we're going to the playoffs.
Yeah.
Question number 2, Jon. What is one book that you'd recommend for our listeners?
Oh man, I've been reading a book, High Output Management. It's by Andy Grove, former chairman and CEO of Intel. It's a bit heavy, but super interesting. Like he's a really interesting guy, and he's got a super interesting take on just some like simple ways of viewing management, not necessarily applicable to Impact Commercial with 8 people, because I think they had 300,000 at when he was in there, but just still very interesting.
Quality over quantity. It's not the number of employees, it's the quality of employees. 8 good ones is better than 300 duds.
Totally.
There you go.
Agree more.
I'm sticking with the hockey theme here. John, who would you trade? Pedersen or Miller?
Oh, right now, geez, I could get some hate mail for this one, but
yeah, I'm setting
no
you up
matter
for
how
it.
I answer, I think Pedersen, I mean, Miller's just playing so much better, but I could give you a better answer if I knew, what the actual dynamic was, who was the biggest sort of shit disturber in the dressing room, but it feels like Miller's pretty red hot right now, and Pedersen's gone pretty quiet.
I think it's hard to replace his passion. And I think that's one thing I think people get frustrated with Pedersen. Is you're making just under $12 million. And when they interview you, it just feels like you don't care. And I'm not saying he doesn't care. He just doesn't have the same emotion like he cares versus Ryan Miller obviously wears his heart on his sleeve. So I would move Pedersen. I think we're going to have to eat the contract though. But I would move Pedersen.
Unfortunately, that has to be my answer. Yeah.
There you go. Adam.
Question number 4. You can have a gigantic billboard anywhere with anything on it. What would it say?
Oh man, little Tim Ferriss flavor. That's a tough one. What does it say actually on my coffee mug here that I really like? Great things never come from comfort zones.
Oh yeah.
Don't
get too comfortable.
Yep. Good point.
Yeah.
Good point.
Yeah.
All right.
Got to put yourself outside of that comfort zone.
Next question up. If you could do a business deal with any business person out there, who would be your dream deal maker?
I know from a shout out to one of your past guests, but not that Sam Zell was one of your past guests, but he was a favorite of one of your past guests. And
Jordan McDonald brought it up. It was Jordan McDonald brought up the book.
Yeah. So I read it after that, and that he was just an amazing business guy. So and then I also that's such a tough question, but Ray Dalio I've been following pretty closely, and he's an incredible leader and sort of thought leader as well. So probably between those two.
Last but not least, what are you binge watching these days, John?
1883. That was the easiest one.
1883.
Is that on Amazon or Prime, or where would I find that one?
It's the prequel to Yellowstone, right? So.
Oh no.
Does it have that the woman?
I can't believe you guys don't know about this.
Oh man, the Yellowstone. If you go back and listen to like the first 10 episodes of this program, like years ago, I remember when Adam and Matt pitched me on Yellowstone as this like real estate show.
We'd only watched one episode.
And then I thought, I'm like, yeah, this is a great show. This is like the old Wild West cowboys that own all the land. And I remember watching 2 or 3 episodes, and I'm like, do you guys lie to me? Like, you don't like me or what? But okay.
I didn't get that into Yellowstone. I got tired of it pretty quick, but I've really liked 1883. It's like obviously goes back to the very beginning when they were trekking across the plains, trying to stake a safe place to live, and it's pretty cool, really cool.
Nice,
like scenery of. It's probably filmed in Montana, and it's
and Sam Elliott. You can't go wrong with Sam Elliott. So that makes sense.
There's a ton of big names in it, big cameos. It's pretty cool.
John, how can people find out more about what you're up to, and of course, Impact Commercial? Probably
the best place to find up-to-date information is on LinkedIn. Impact Commercial's page on there. There's lots of info on our website as well, and all our contact information's on there. So we welcome anybody to reach out if they think there's anything we can do to help.
Amazing. Well, thanks again for taking the time.
For sure, guys. You as well.
Thanks so much, John. Take care. There you have it, folks. Our interview with Jon Switzer, managing partner, Impact Commercial. Always great to have John on.
Yeah.
I love that guy.
It's funny, but I mean, we all live in Vancouver. We all invest in Vancouver. It is starting to sound like we're island pumpers. But it's hard not to, like, I feel like there's a combination of On the residential show, we're hearing a lot of people that are really tapped into the development industry or like lifelong real estate investors that are buying real estate, residential real estate on the island.
Yeah.
And then on the flip side, there's a lot of interest from the commercial, in the commercial market on the island. It's a very tight market. It's hard to get good product. And the other thing is that what's interesting though is that Jon was saying that it sounds like there's an appetite from a lot of different lenders trying to get into that market. Yeah, so that's probably a good sign.
It's a great sign. I think if you go back like 10 years, that was one of the challenges sometimes maybe with the BC interior market and the Vancouver Island market is the lending pool was so small because some of the larger lenders weren't as comfortable to go in these markets. And then you were very relying on like local credit unions and all of that stuff to really get your funding from. Now you're getting more big banks involved, obviously. You still have all the local credit unions, but to Jon's point, it sounds like you have like lower mainland credit unions now that also want to get a piece of the action, which is just a comfort thing. You got, above average population growth. You got good economic drivers. You got affordability there that's still there in some markets versus over here. So I think the BC interior market is also one thing that I think is still pumping hard and still a great opportunity. And Vancouver Island, not take away from the lower mainland, but there's great opportunities in a lot of these markets around us.
Amazing, Cory. Well, if anyone wants to talk about the island or the interior or anything else, or of course, Vancouver, how can they get in touch?
They can reach out to us anytime in our Vancouver office, 604-428-5255. They can visit our website, williamwright.ca, or fire me an email, Cory@williamwright.ca. Always love hearing from listeners.
Incredible. Well, have a great week, and we're back next week with another great episode.
Thanks for listening, guys.
Subscribe today.